Ladies, have you been wanting to make a change, but you don't feel ready? Here's the truth. Readiness is a lie. The model of confidence for women is backward, and we need to flip it. I'm Cara Moeller Poppitt, author of a new book, Big Freaking Change. After coaching thousands of women, I discovered action gives us confidence, not the other way around. If we wait to feel ready, we'll wait forever. So if you're ready to get unstuck and step into the life you've always dreamed about, visit bigfreakingchange.com right now and order your copy. Welcome to the Big Freaking Change podcast, where we dive deep into the stories of those who took bold action, embraced uncertainty, and transformed their lives without ever feeling ready. I'm your host, Cara Moeller Poppitt, author of The Big Freaking Change and the creator of the Get Unstuck Cycle of Change model. Each week, we'll sit down with remarkable individuals who have taken bold steps in their lives, personally and professionally, to make meaningful change. Whether you're seeking a career shift, personal growth, or a boost in confidence, our goal is to inspire you to stop waiting and start taking action. Hello, everyone, and welcome to Big Freaking Change. I'm your host, Cara Moeller Poppitt, and I'm so delighted to be here with an incredible wealth advisor, Tim Conlin. Tim, thanks for coming to our show today.
Welcome. It's great to be here.
So before we begin, Tim, I'm just going to read your bio so everyone knows the brilliance you bring. So with over 3 decades of experience in wealth management, Tim helps clients make wise decisions amid uncertainty. Known for his calm, thoughtful approach, he combines technical expertise with behavioral insight to guide families through market cycles and life transitions. Tim holds a CPA, CA, and CFA designations. So, Tim, thank you for dropping it like it's hot today. We're talking about the market. I know there's so many different changes in the marketplace. And for people that don't have a lot of emotional endurance or we get really stressed out by the changes, let's start with that because I think that would be very valuable when we're going through different cycles.
Yeah. Well, I'll start with a quote from your book. I read a quote that said, "The human brain is a predictive machine in search of the familiar." And we live that every day in the investment world. We are naturally inclined to look for patterns and look for certainty. And many times it's uncertainty that we have to learn how to embrace and learn how to accept as part of the journey. And so part of the problem with being human is we have a few things that are working against us. Our biology and psychology, we have biases and we have perhaps tendencies that our limbic system take over, and the flight or fight response starts to cause us to wish we maybe weren't investing at a certain time. Recently, with some of the issues with the U.S. and what we're seeing with tariffs, there seems to be ever-changing news, and it's putting people on edge. And I think when we talk to our clients, we try to encourage people around the idea that it's really their temperament that's going to differentiate themselves. It's not their IQ, it's not effort, it's not knowing more. It's actually how you can kind of control maybe sometimes your innate response to maybe a stress. You think about it, if you're, let's say, in a really stressed state or you're panicking, you're upset, the worst thing to say to a person who's panicked or upset is relax, right?
Oh my gosh, I know.
Yeah, it's the worst, right? I've made that mistake in my marriage a few times. You don't do that.
Yeah.
So the way to deal with panic and with these emotions is before they start. It's some preparation. It's some understanding of what you're signing up for. And in our team, we talk to clients about this price of admission. So if they're going to invest in the stock market, there's a price of admission being inevitable drops and panics. And the way to differentiate yourself again is to control your temperament, is to not act when others are acting, not to panic. So it's preparation by understanding the price of admission. What is the price of admission? Well, if you're investing in the US stock market for the last 70 years, you're going to experience a 10% drop about every 2 years. You're going to experience a 20% drop about every 3 years. And then maybe once in a generation, you're going to see a real doozy, maybe a minus 50. So if you understand that's what you're signing up for, then you have to prepare yourself for that inevitable. And know that there is a prize at the end, or there's a pot of gold at the end of the rainbow. And if you're willing to bear and endure that risk, that volatility, the prize works out to be about 6% return above inflation, the ability to beat inflation by 6%. If you stick your money in a bank account or in a real safe haven, you're barely going to make the rate of inflation once you pay taxes. So there's a significant prize, but it's really only appropriate for people who are willing to look through a longer term lens, a lens of 3 years, 5 years, 10 years and beyond. Mm-hmm. But there's great rewards to doing that.
Yeah. And Tim, talk to me about the behavior that you see when the stock market fluctuates and we have these highs and we have these lows and we kind of freak out emotionally, right? It's a huge change in our wealth. It's not realized yet, but it's on paper and we feel that. What are the behaviors that you experience and you help your clients kind of walk through and get them in the right state of mind again?
Yeah, it's kind of a little bit to the Stoics, this idea of suffering. Mm-hmm. Suffering in your imagination for something that it's easy to extrapolate suffering that you're currently in and extrapolate that if it's down today, it's going to be down tomorrow and then I won't have any money left. And you need to kind of hack into maybe your psychology and understand that suffering something that hasn't happened yet isn't helpful. And then really go back to sort of trusting the science and looking at really long-term patterns of returns and know that every couple of years it's very normal and accept it as very normal. And again, one of the other things that can hijack us is actually media, social media, financial press. We say to our clients, the financial press and the CNBC and BNN, they're not there to help you. They're there to sell you something. They're there. So, there's a hijacking going on of your emotions, your amygdala to get you attracted to looking at what they're offering and information they're offering. But it'll often come with gurus and analysts who claim that they know the direction of things and they really don't. No one really knows the direction in the short run. Yeah. But in the longer run, that's what you have to kind of anchor yourself to is the longer term principles.
Yes. So Tim, talk to me a little bit about your biggest freaking change that you've made and if you felt ready and what you learned in the process.
Yeah, it's interesting. I might even mention your dad in this because he was part of the small group of people that inspired me to give up on a career that was pretty mapped out. There was literally a brochure I could look at that gave me a timeline of what my career might look like as a CPA. And I had a desire to move into something new and different in wealth management, which was fairly early days of that. It didn't have a great sense of certainty, but I was fortunate to have people to kind of encourage me along. It was also a business and an endeavor that didn't require capital, so I didn't have to convince anybody to give me money. It was sweat equity. It was the only investment was of my time and the risk involved in perhaps embarking on a career that wasn't going to pay off. But you do these things maybe sometimes from a place of belief in yourself and maybe a little bit of naivete at the same time kind of helped me.
Yeah. And what would you say to entrepreneurs or people that have a promising career that want to shift directions? What's your advice and feedback from what you learned?
Well, it's so worth it to bet on yourself.
Yeah.
You can look back at it, and I've been fortunate. I can look back, and I remember being, I think at one time I owned the worst car in the city of Calgary. So I had people who wouldn't follow me 500 meters behind because it blew smoke behind me. And it's fun to reminisce about, thinking about what would have been had I chose the certain route. But, I think it's, again, like investing. I think I'm drawn to uncertainty. I think in the financial markets, it's really cool. Different asset classes, different investment choices yield different returns. And it's interesting, the whole financial system is based on the idea when there's more certainty of an investment, let's say like a government bond, it yields a lower reward. But the greater willingness you have to bear uncertainty, you don't know for sure if it's going to work, but you believe in a core belief, a core principle of what you have to bring to the table or what this investment has. So as you move out the spectrum of growth to the stock market or even to venture capital, the rewards and the prize gets bigger for those that are willing to look through, a long-term lens. And I think it's the way I viewed my career. I was willing to take a short-term hit for a long-term uncertain potential.
Yeah. And I think it's a really great reminder for everybody is that when you invest in yourself and you bet on yourself, it's the best investment you can make, right? Because you're living in your life, you're going to pursue your dreams, your goals, your ambitions. And if you're not pouring into yourself, like who really will, right? And following that voice and having the courage to step out when there is so much uncertainty often will yield results. It might take longer than you anticipated, more work. Like I remember starting my business, everyone thought I was crazy. They're like, you're never going to make money. Financials are against you. Dance studio owners, like you're going to have this short career. Even my dad was losing sleep. He's like, I think you're making a mistake. Like the numbers don't work. But I was like, I'm going to figure it out. And I had all these different business case scenarios. And I was like, okay, this is going to be like worst case scenario, best case scenario. And as long as you have a plan and you have that belief and that passion and that drive, really, then you can kind of go through the highs and lows and know that you're going to get to a great place.
It's a refining process, right?
Yes.
It's sort of stepping out and understanding. Maybe don't refine yourself before you launch. The launch itself will give you real-time refinement. And
oh yeah, I love that.
And I remember just thinking back of embarrassing things I thought I knew and I didn't know. And fortunately, they weren't catastrophic or didn't have financial consequences. But you just have to trust that you'll be refined, and that real-time refinement. It's interesting, the power of real-time refinement. Silicon Valley has a whole culture around that, this MVP, this minimum viable product, and they know the power of refinement. So these venture capitalists and angel investors will give founders an opportunity to launch a minimum viable product that isn't really ready for prime time, but they know the power of that refinement. And you can think about that yourself as a minimum viable product. When I was reading your book, I was thinking about that.
Good.
Yeah.
Thank you.
Yeah.
I think that there's so much truth in that. Like my core message is that readiness doesn't exist. And we all wait for this magical feeling to feel ready. So ready to invest in the stock market, ready to start your own business, ready to move, whatever the big thing is. And we wait for this magical feeling and we disguise it as, feeling like we don't have enough time, we don't have enough money, we don't have enough energy. And we can all find a million reasons not to do something, but it's about doing it and doing it when you don't feel ready, because after the result and the reward is your confidence. And I think this really plays well with the stock market is a lot of people don't feel ready to invest because they feel that they don't have enough money or it's not going to make that much of a difference. And we know the time value of money is so critical. Can you speak to that kind of macro level and then how it impacts our decisions in the future?
Yeah, when you think about being ready to invest, I think I just want to address that first. The good news is the best investor in the world, or what many people regard as the best investor that ever lived, is Warren Buffett. And he downplays the need for IQ and intelligence. And several quotes, if you look them up, things to the effect that, IQ is not the differentiator, it's temperament. And so the ability to again, withstand some pain and some struggle. And so that's the first thing about it. And, the other good news for a young investor starting out or a new investor just beginning is that you can start out with pretty much next to nothing now. There's platforms for you to buy very inexpensive exposure to the broader stock market, which is what I would recommend for someone with a pot of money that has a long-term purpose. That's 3, 5, and 10 years and beyond. And you can buy an exchange traded fund that invests in the US stock market and invest in a systematic way. So when I look at, the time value of money, I just have a little illustration that if you start early, so there's an example of a young investor, let's say starting with $400 a month at age 25, and they stop at age 35, and they make that 6% I was talking about. But they only invest for 10 years or only save for 10 years. They'll have $48,000 invested, but by the time they're 65, they'll have $395,000. For the investor who starts a little later and starts at age 35, they can save that $400 a month for 30 years till age 65, and they'll have invested $144,000. By the time they're 65, they'll have $402,000. So in other words, they have to save for 30 years, where the 25-year-old only has to save for 10. So it just gives you an illustration of the power of compounding, and what that can really do for you if you embrace it early. It's never too late, though. If you're past 25, past 35, we've had clients come and see us quite late in life, and we're able to kind of encourage them along to get on this journey of kind of bearing risk and bearing this price of admission. And we're seeing people have success even late, but the earlier you can start, the better.
Yeah. And I think earlier is really about peace of mind, right? If we know even for my children, investing in their RESP and making sure that I know that they can go to university and it's covered, and I have that gives me peace of mind, that gives me security, and that I can pass that on to my children. And I think that's such a great gift. Is why do we invest? We invest, I believe, for peace of mind so that we can do the things we want to do in life. What do you see gets in people's way from starting the process?
Well, I do think it's a lack of confidence.
Yeah.
A lack of belief. I think there's so many voices out there. Maybe sometimes they're confused by so many voices telling you to do one thing or another, or maybe crypto or various different alternatives. And so I think it's a very confusing landscape. But if you just go back to understanding that the greatest investor that ever lived suggests that really you don't really need to brute force know everything and have the highest IQ. You just have to really trust in those longer term trends and longer term truths, about investing.
Yeah. One thing I remember, Tim, working with you when I had my initial meeting was I said, look, I don't understand the stock market. I'm not going to be reading it every day, but here's the life I want. Here's what I want my end goal to be. Here's the money I might have to invest in, a certain amount of time. And I think having the ability and the courage to say, like, I don't understand, or when you were explaining things, I'd say, oh, could you explain it a little differently? Because we are not specialists in an area. And I think sometimes that holds us back from taking any action. And what I hope listeners will gain is that you don't need to be an experienced investor to participate, but you need someone, or you need a company or an advisor that's going to help you reach your goals. And having that clarity of what you want your life to look like really gives you peace of mind. And then you can, not worry about it so much. I think a lot can come down to financial literacy, right? We don't understand all the terms. We don't really understand the different taxation, the different benefits if you have a business. Talk to me about what you see for business owners, perhaps maybe get in there a block in their mindset, and how you help them through that.
Yeah, I think there's, maybe a bit of myopia that happens when someone gets in the business and they start generating excess cash flow in excess of what they need to go back in the business, and then flicking the switch to say they go from really focusing their whole their day and their time on building their business. And when they reach the point where the business doesn't require reinvestment, is shifting and understanding that there's a benefit to then diversifying, right? Investing in other types of businesses, either through the stock market or in other asset classes. So that's one of the shifts I see, because there's always this comparison of the returns they could make in their business versus the returns they'd make in an investment in the public markets. In terms of like taxation, I guess one of the frustrations is the landscape seems ever changing. And certainly last May we had a budget that was announced that had major impact for our clients that have corporations, and it ended up not getting passed. That budget didn't get passed, so people started wanting to plan and get out in front of this tax change. So it can be frustrating, and I think that's maybe just another thing to endure not just market volatility, but the landscape changes just naturally. Politicians change, policies change, but really to trust that, you can find a path and you can innovate and adjust and adapt and, refine just like you refine yourself. So I think it's just maybe not becoming exasperated by these changes, and just understanding it's part of what you're signing up for. It's the price of admission in a way.
Yeah, and it's keeping that perspective too, right? That there's going to be changes and being able to embrace change. There's a theory called the loss aversion, and it basically states that the human condition, we have a more negative response in our brain chemically when we lose money than when we gain money. So if we were to lose $100, that hurts more, and there's more of a reaction in our body and our brain chemistry than if we were to gain $100. And I think that plays into the stock market, right? We want to just keep our money safe. So we'll just keep the 1% in a savings account because we're scared of losing. And that's the human condition, that it's stronger than the reward for gain.
Yeah. 100%. And I see that in practice. But again, I think what we're talking about and even what we're doing today is providing people with information to understand that exists, and preparation is just, understanding what's to come.
Yeah.
And I think that's helpful.
So if someone is new to investing in the stock market, where do they start? And what is they have to understand that it's long-term. They have to understand there's volatility. They have to have clarity of what their goals are. Am I going to take this money out in 10 years? Is it going to be my retirement fund? What other factors do they need to really kind of think about before investing?
Yeah, I think, innovation, and maybe today's conversation is about innovation, but what markets and what geographies of the world are known for innovation? And if you have a really long-term view, a pot of capital that you're willing to invest 5, 10, 20 years and beyond, I think it's important to look for those markets that are innovating and those geographies that are innovating. And it's measurable. You can look at the trend in a country's GDP, so productivity or income per capita, per person. And if you see that trend growing versus other countries, that's a pretty good indication that that country policies or whatever inertia is drawing innovators into that country. And I would say the United States, even for all of the bluster and stress that we're experiencing, especially as Canadians hearing about changes to tariff policies and how other countries can trade with the U.S., we see that the U.S. is a leading powerhouse. It's a destination for innovators. If someone has a great idea, chances are they want to go to the U.S. market and or maybe even move their. We see time and time again companies moving their head office and their mind in management to the U.S. I still think, at least I favor innovative businesses and businesses that are adapting and changing and refining, ones that aren't maybe as held back by legacy, either regulations or just legacy approaches. And so, it goes back a little bit to that Silicon Valley idea, this minimum viable product, that ecosystem that really encourages launching. And it's interesting, the incumbent companies that maybe exist, they're at a disadvantage with innovation. It's harder for them to take a risk. So again, just a bit of a metaphor for your message is that small is good. You can be more competitive, you can be more impactful. Because I'll give you one quick example. When ChatGPT launched 3 years ago, it was launched as very imperfect. It didn't really perform all that well. But the key message is it grabbed people. This is so cool that now we can literally chat and get answers, just like human to human. And of course, the growth in users was off the charts. But the incumbent company, Alphabet, had a similar product. It sounds like it was perhaps superior in a lot of ways, but they were unwilling to launch it. The incumbent company was fearful of it tarnishing their brand, and they didn't want to launch an imperfect product. Everything has to be perfect because your standard is so high as the incumbent. And so again, I'm going off on a bit of a tangent, but back to that innovative culture. So align yourself with innovation and areas and sectors of the market that provide that kind of exposure.
I love the example you just gave, because in life, a lot of women will struggle. Like, we over procrastinate because we over prepare, striving for perfection. And I see this a lot in business owners too. We have a great idea, a great concept, but we're waiting for perfection before we launch. And there's so many missed opportunities that happen just because we're waiting and we're refining. Maybe you can speak to some of the businesses that you've seen over the years that have waited and didn't feel ready, or people that have waited and didn't feel ready, and the missed opportunity cost. There's always an opportunity cost, right?
You didn't set me up for this, but I actually have a prop.
Oh, good.
So my prop is something I bought on eBay. It's an old Kodak camera.
Great.
And I keep that as a reminder of a company that dominated film photography. I think there were over 90% market share globally in film photography. And the great irony is they invented digital photography. They had a large hand in inventing the technology, but were unwilling to embrace the technology and take the risk of giving up on something that was a cash cow. And it ended up in the failure of the company, the bankruptcy of the company. So if there's any Kodak remaining, it's a remnant of that bankruptcy. It's a great illustration of that concept. It wasn't a fully developed technology, for example, like the digital photography didn't really quite know how they were going to monetize it, but still had a product that was going to develop and didn't trust that it could be refined and figure out how to make a buck selling or offering services around it. Lots of other examples of companies that wait a little too long. I think, when we look at even in, financial services and banking, I think by being large, sometimes it causes companies to be a little bit resistant to change. I think of the digitization of money and the digitization of banking. It wasn't led by the big stodgy banks. It was led out of, a startup culture. And even though all of the resources and understanding of regulations were embodied in these large incumbent companies, smaller companies like, Block, which was Square, and PayPal were kind of some of the early innovators and disruptors that now have forced a lot of the big incumbent banks to change. But many of those large incumbent banks are still sitting on, their data is still sitting on 50-year-old systems that were built in the 70s and 80s, and they haven't made the change to cloud.
Isn't that wild?
It is wild, and it's a risk, but you can imagine being on the board of directors of one of the big banks, a dozen years ago or 15 years ago, and some hotshot recommending, that we shift our systems to the cloud. We would say, cloud, that sounds scary. No, we're not going to do that. We're going to stay with these old mainframe systems. And so now they're at a major disadvantage, right? Because they won't be able to adopt and change. And these legacy systems are holding them back from embracing, all the wonderful tools we'll see from AI and everything else. So I think that's another example that stands out to me.
Yeah, those are great. Tim, what are some tools that you use or you help your investors? So we're talking about emotional endurance, but when there's a big change, and we're talking about transitions in life. So you help a lot of families kind of prepare for the different seasons of life. What are some tools that you help them kind of keep their mindset strong? Because I think it's a mindset game more than anything. And then you can talk about the behaviors, but to really keep them focused on the long game or their real goal when we do have disruptions or transitions.
Yeah, I think, my first point that I address is the emotional state. Sometimes in the event of a really traumatic situation, like an unexpected death or divorce or anything like that, I really recommend that people pause a bit. This might be the contrary to some of the messaging about moving forward, but you really need to make sure your mindset is right before making any big decisions, and make sure those feelings are well processed. Let's just put it that way. In the event of, let's say, the death of a spouse, it's not time to go guns a-blazing, selling your properties and do everything within days or weeks of a traumatic thing like that. So that's usually where I start. But once we're at that stage and we see people in a state to make decisions, I tend to break life up into 3-year chunks. And if you have, as a rule of thumb, any expense or need or probable investment you want to make that is 0 to 3 years, the stock market isn't for you. It's better because the variability of it's just too unpredictable. So in our practice anyway, the way we advise people is really just to root out what priorities do they have where cash will be required in 0 to 3 years. And then once we identify goals that are longer than 3 years, that's when we can start using the power of compounding in the stock market. Provided, again, we've explained really well the price of admission, what we're signing up for. Make sure we do that when we're not in panic, because the worst thing you can say is don't panic. So let's prepare for the inevitable where we all feel it. And I feel it too. I don't sleep really well when things aren't going as I planned in the short run. So that's really one helpful tool that we use. We call that the buffer, or investments that have a high probability of holding their value in the event of a market downturn. So anything that we determine has a 0 to 3 year horizon, we'll invest in, really high quality, low risk investments like short-term government bonds and that sort of thing. But we have great trust and belief in the long-term power of the stock market, the public stock market, and especially, again, that innovative market. And we'll try to encourage people along and coach them along to willingly find a place where they can willingly bear that risk, because the prize is so huge. It doesn't sound all that sexy, but if you can make 6% real return and prepare your financial plan around that, you can accomplish really anything financially that you want. And to the point you made earlier, money is, how do you describe it? Money is
it's peace of mind for me that I can make the decisions and have the experiences that I want.
Yeah, I'd say for me, money's an enabler.
Yeah.
But there's a book I'm just kind of reading right now called 5 Types of Wealth. There's other wealth. There's other wealth that's important to us. Of course, our family and our health, and money's an enabler to help you get the most out of those other aspects of how we measure wealth. And I think it's a really cool thing to think about. And when I got into the business of wealth management, it was all about the scoreboard was how many zeros are after my clients' accounts, and enriching them from a point of view of the scoreboard being how much wealth do they have in terms of money. But now I'm realizing there's more to it than that. It really is enabling other areas of wealth and other choices. And again, peace of mind is a huge part of wealth.
Yeah, for sure. Tim, to wrap up today, I'd love for you to talk to me a little bit about courage and what your definition of courage is, and how you encourage your investors and your clients to tap into courage.
Yeah, well, I think courage is the ability to act when there's no certain outcome, and it requires a willingness to embrace uncertainty. And that's what courage is. It comes with a bit of education. Doesn't require a 180 IQ, but it does require at least some upfront work to understand, what you're signing up for.
Yeah, that's great. And Tim, I wanted to personally thank you for being a sponsor for Big Freaking Change. Richardson Wealth has donated funds to help when I speak at post-secondary universities and colleges to provide a copy to all these students. And I was at the U of C and I was at Bow Valley, and people were crying and men and women were coming up. And I just want to thank you for allowing me to extend my reach by helping these people. So thank you to Richardson Wealth for supporting us.
Thank you. That's great. It's great for us to be involved. So appreciate that.
Thank you. And listeners, as you are going through your journey in life, remember the time value of money. Remember to be aligned with your goals and your vision, and to trust the outcome, and to understand that change is inevitable. And as Tim said, it's in the refining of the process, right? We discover more when we wait to feel perfect or ready. We often miss out on opportunities and sometimes our own lives as well, because we're waiting to go on the trip or, buy the house, and our lives pass us by. So really embrace that. And if you're looking for financial advice and feedback and perhaps investing, please reach out to Richardson Wealth. They're a great company to work with. They take time to connect, to understand your vision and values, and then invest appropriately. So thank you, everyone, and have a great day. Bye for now.
We hope you enjoyed this episode and would be so grateful if you could share it with someone else that could benefit from it. Let's remember to change our relationship to change itself and take aligned action. If we want to make meaningful changes in our lives, we need to embrace stepping into the next version of ourselves in the process. Remember, stop waiting to feel ready and start taking action today.